Welcome back to the Mortgage Reports. Today we're tackling a question nearly every homeowner asks at some point. When is it actually worth refinancing your mortgage? Maybe you've seen the rates drop, maybe you just want more wiggle room in your monthly budget, or maybe you're wondering if shaving off even a 1/4% is worth the hassle. Well, stick around because we're breaking it down with real numbers, real examples, and some surprising real-world scenarios where refinancing made a huge difference. First things first, why do people refinance in the first place? Well, it's simple. People want to save money. A lower interest rate can reduce your monthly payment, which frees up cash for savings, emergencies, or even fun stuff like vacations. But refinancing isn't just about lowering your payment. Some people use it to shorten their loan term, like switching from a 30-year to a 15-year mortgage, so they can build up equity faster and pay way less interest overall. Others want stability and switch from an adjustable rate to a fixed rate mortgage so their payments stop changing every year. And plenty refinance just to kick private mortgage insurance to the curb. So refinancing is really a tool and the benefit depends on your goals. So bottom line, refinancing is a toolbox and the right tool depends on what you're trying to fix. Okay, so how big of a rate drop makes refinancing worth it? And is 1% the magic number? Well, the old school rule, wait until you can drop your rate by at least 1%. And honestly, that's still a good benchmark. Let's take an example. If you've got a $400,000 mortgage at 7.5% interest, your monthly principal and interest payment is around $2,796. If you refinance down to 6.5%, that drops to about $2,527. That's a savings of $269 every month. Yes, you'll have to pay closing costs, let's say around $8,000, but you'd break even in just over 2 years. If you're planning to stay in the home longer than that, it's almost a no-brainer. But here's the twist. Even a 0.5% drop can make sense. Using that same mortgage going from 7% to 6.5% saves you about $133 per month. That's smaller, yes, but your break even stretches closer to 5 years. And if you know you'll be in the house for the next decade, those savings stack up more than $15,000 over 10 years. Here's a real world story. A young couple with a $350,000 mortgage at 6.8% refinanced down to 6%. Their payment dropped $180. Not life-changing, but it gave them breathing room to max out retirement savings and build an emergency fund. Over 5 years, they'll pocket more than $10,000. That's not just savings, that's freedom. On the flip side, when is refinancing not worth it? Okay, there are definitely times it's a bad deal. First, it's not a great idea if you're already deep into your mortgage, like 15 or 20 years in. Restarting the clock with a brand new loan could cost you way more in interest overall. Also, if the rate reduction is too small, like just a 1/4% difference, you might only save $40 to $50 a month. And if you're paying $6,000 in closing costs, it would take you over 10 years just to break even. And lastly, it also might not be worth it to refi if your credit score isn't strong. Lenders might ding you with high fees or worse rates, so your savings disappear. In short, refinancing can be powerful, but only if the math works in your favor. So how do I figure out if refinancing makes sense for me specifically? This is where the break-even analysis comes in. Step 1, figure out how much your monthly payment drops. Step 2, add up all the closing costs, usually 2 to 5% of your loan. And step 3, divide the cost by the monthly savings. That tells you how many months until you break even. Let's say your payment will go down by about $200 a month and your costs are $6,000. Divide $6,000 by 200 and that's 30 months or 2.5 years. If you know you'll live in the home for at least that long, refinancing is a win. If you're not sure you'll be around past that point, it probably doesn't. And remember, There are creative options. You might roll the closing costs into the loan balance so you're not paying cash up front. You might choose a shorter term, say refinance into a 15-year loan instead of another 30. Or you might opt for a no closing cost refinance for instant savings. It's about matching the refinance strategy with your lifestyle and future plans. So here's the bottom line. Refinancing can be a fantastic way to save money, but it's not always a slam dunk. A 1% rate drop is usually a win. A 0.5% drop can still be worth it with the right circumstances. And a tiny drop like 0.25% usually isn't unless you've got super low costs. The trick is to run the numbers, savings versus costs versus how long you'll stay in your home. If you're thinking about refinancing, grab a calculator, talk to a few lenders, and see what works for you. Thanks for hanging out with us today. Don't forget to hit like, subscribe, and drop your refinance questions in the comments. See you in the next video.